From the morning reading, financials lead strong and broad rally. Amazon lower after earnings. The broad indices rallied on Friday, led by the financial sector. Financial stocks opened higher Friday morning, led by many of its components, on word that the president would sign an executive order calling for a review of the Dodd-Frank Act, another indication that regulations might be reduced and bank profits rise. Breadth strengthened compared to the prior session as advancers led 2382 to 647 on the New York Stock Exchange and led 2096 to 748 on the Nasdaq. On the S&P 500 snapshot, the week closes near all-time high. On Friday, the S&P opened higher, then it reached all week and jumped within the first few hours. The index spent the rest of the day in a close range, ending with a daily gain of 0.73% week over week. The index saw a gain of 0.7%, ending within 1 point of its all-time high. The U.S. Treasury puts the closing yield on the 10-year note at 2.49%, up 0.01 from the previous close. In other news, the financials lead Friday's stocks bounce, so do small caps and transports. Healthcare is week's strongest sector. HCA Holdings achieves bullish breakout. Amgen surges. 3 ETFs that offer entry into stronger healthcare groups outside of biotechs and drugs. We'll comment on in just a moment. Dow and the S&P 500 end the week on a strong note. What started off as a soft week for stocks ended on a strong note. Friday's gain was enough to keep stocks basically flat for the entire week. But there was some improvement on the charts. The daily bars on the chart showed that the Dow Industrials jumped 186 points for 0.94% on Friday. That was more than enough to keep it well above its 50-day average and chart support along with its January low. Also encouraging was the 14-day RSI line, bouncing off the 50 level for the second time since mid-January. That's usually a sign that the market is consolidating rather than correcting. The only soft note on Friday was volume, which didn't match the price gains. The S&P 500 also saw improvement. The chart shows the S&P jumping 16 points, 0.73% on Friday. If you look closely, you can see a bullish short-term pattern called an island reversal. That pattern is formed when a gap down, followed by, within a few days, of a gap up. That pattern usually signals higher prices. In other reading, even though the S&P 500 has rallied 6.6% since election day, speculators haven't fully embraced the rally. While margin debt, money borrowed to purchase stocks, moved higher in November, December, data erased much of that gain. And overall, margin debt as a percentage of GDP remains well below the peak level in April of 2015. Peaks in market debt typically precede peaks in the market. So if margin debt fails to reach new highs in the months ahead and instead unexpectedly displays a decisive drop below its most recent low, then risk of a bear market would increase substantially. The industrial average is performing better than its siblings. The transports and utilities remain well below their all-time highs, while the industrials came oh so close to another record. Prior instances have been minor short-term negative for future returns, but not much beyond that. Volatility expectations collapsed yet again. After Friday's news and market performance, the VIX dropped more than 8%, an unusually large move considering it was already exceptionally low. Similar drops led to large increase in the VIX going forward, but mostly flat to positive returns in stocks. While stocks didn't usually drop much, the risk-reward over the next few months was about even most of the time. Once again, 50% of the indicators are showing extreme optimism. The only 2 days in this bull market that has happened were March 2nd, 2015 and January 4th of this year. Both coincided with at least a temporary halt to rally attempts. The latest commitment of traders report was released, covering positions through Tuesday. Once again, hedgers were selling energy contracts, pushing bets against crude oil to another record. They were also aggressive in selling silver and copper. There were no new extreme long exposures of note. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:07 a.m. Mountain Time, and I'm recording this in preparation for the market day of February the 6th, 2017. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and bounce into the morning report. And at the time of this cut, we got a little bit of weakness, but nothing of any significance across the four U.S. broad-based indices, the S&P futures, Russell futures, Dow futures, and Nasdaq futures, all just below scratch. Crude oil is up about 0.25%. Euros down about 1/3%. Long bonds up about 2/3%, as is gold futures. And overseas action, looks like everybody's open. China up about 0.5%. Hong Kong up about 1%. Japan up about 1/3%. Germany down about 0.5%. United Kingdom up just above scratch. In terms of macroeconomic reports for today, of note for the United States, you have mortgage delinquencies, and that looks to be about it. That's either an orange or a red flag report. And looking forward to tomorrow for the United States, I see a couple yellow flag reports. It looks like nothing of note for tomorrow. Current volatility conditions, short-term VIX at 9.19. You heard one of the morning authors mention about the bit of a crush on volatility on Friday. Skew still elevated, coming in at a 133.25. IV percentiles, 3 of the 4 are in single digits, so continue to be exceptionally low. And the S&P at a 9, the Russell at a 3, the Nasdaq at a 5, and the Dow, the single double digit, coming in at a 16. We did have standard deviation size moves on 3 of the 4 indices on Friday, with the S&P coming in with a 1 standard deviation move on a close-to-close basis, and the Russell and the Dow coming in with 2 standard deviation size moves. So some big bullishness that was exhibited there. We'll go ahead and go to the charts and get this over to white, where it's a little easier for you to see on the video. And you see with Friday's action, it took us right up to the high of the recent range. And another thing I want you to notice here is we've had a couple big scale wedges that have been forming. And the first one, we're going to have to dial this thing back a little bit. Well, just a second here. Sorry about this. There we go. So if you go back to February of a year ago, you notice we have this big wedge forming. Well, if you put this in context of a much longer scale pattern, you can see you have the big bullish pattern, and then you have this kind of wedge, and this would be a bearish wedge, potentially. Now, you know, it's a wedge in that it's not a channel, it's not parallel, they come closer and closer together, and it's not perfect because I did not include the election volatility. That bottom point was way down here. I throw that as an aberration. It corrected within hours. So anyhow, it's just something to look at, because you see that wedge there, and then you look at this, and now we have a shorter term wedge forming. Now, if these were to resolve, they would resolve to the downside. Now, at the same time, we certainly have had a number of dynamics come into place in the market, which would seem to be very supportive of the market. And we really see a lot of support, including key moving average lines. You've heard about a couple of key bounces from one of the morning authors just in the last week. And then, of course, you have the cloud and everything down here. So a collapse that would fulfill these wedges would have to bring our price action well down below this area here. And that's really kind of hard to see. But anyhow, I noted the bearish wedges. I thought I'd mention them to you. It's just one of those things that, may be some evidence that this thing's getting pretty long in the tooth and that we might have some sort of corrective action coming to us in somewhere in the future. And also on the, let's go back to our regular time frame here. On the Dow, we don't really see that wedge in the Dow. This is more of a sideways consolidation pattern over here. So kind of in contrast, perhaps, to what's happening on the S&P. And frankly, they usually work pretty much in tandem. And then let's take a look at the Nasdaq. Nasdaq, of course, has been bullish, and we do have something of a wedge over here. Though the most recent action, I would probably at this point say, is more of a sideways consolidation pattern. So, again, interesting. And then, of course, the champion of sideways patterns of late has been the Russell. Big Friday action you see, but still, even after that, it's just noise because it didn't even take us quite to the top of its recent trading range. In other markets, crude oil also very much locked into a sideways trading range. Gold, and we continue to watch this with gold, and look at this. I mean, with this action last night, we're on the verge of a cloud breakout on the daily candle, and we've had this big, what at the time was a counter trend high, but a break of diagonal and then horizontal resistance, a flag pattern here, and now new higher highs. So, the short-term pattern is clearly one of higher highs, higher lows, higher high, and we're about to have a cloud breakout. So this whole thing on gold is starting to become far more significant. If we do get a break of this cloud, we're probably going to move up here to the 1300 area, and that probably could happen fairly quickly. So just kind of keep that in mind. And then in some other markets, we'll take a look at dollar. Dollar's been consolidating right at the bottom of the cloud after this big counter trend move to the downside. Bonds also in sideways consolidation. Most of our markets have been in sideways consolidation of late, and really only gold is doing something significant. And volatility, you see where the Friday crush took you down below 11. And last week, of course, we had a new 52-week low below a 10. So exceptionally low levels of volatility, and certainly that's got to play into your strategy selection and so forth at this point. Okay, that's probably enough on the charts. Let's go ahead and go to the daily report. And we continue to have some mixed signals here. This market phase 5 is probably on the verge of flipping back to a phase 3 or 4. Probably phase 4. Hasn't actually done it yet. But, so at the very best, or worse, you could call it, market phase 5, this is a very weak signal. We had that break of diagonal support. We're waiting for kind of a break of the horizontal to kind of put us back up, the horizontal resistance to kind of put us back up into a more bullish phase. And some of the other signals, though, that more clearly bullish, and the 3 market timing signals. The first one from IBD has been confirmed uptrend through all this recent action, and GMI index actually improved on Friday. It's a perfect 6 out of 6 and 8 out of 8 on the GMI2. That buy signal been in place since 11:10, so that's also bullish. Stock charts decision points scoreboard remains locked in this mixed signal stance with the short term and the long term in these mixed signals. So overall bias, we continue to have a bullish bias with the understanding that most moves to the upside will be subtle and we'll have kind of incremental new highs is the expectation. At the same time, to the bearish side, that we would have short and not very persistent and not very severe downside moves. So all the moves with the current volatility and the current mixed signals, would be generally expected to be relatively small both directions. Position sizing opinion, both coming in at 100%. Intermediate term market posture, we have a first day signal strong bull. So the S&P has flipped, and it's flipped a strong bull. Now, we always indicate these are first day signals because they often have a high failure rate when they are flipped. So we want to see that this starts to persist and actually build. It's also against a neutral sentiment line, so that's even more evidence that we could have a lot of flip-flopping back and forth on these signals in this kind of environment. Dow's actually in a weak bear, Nasdaq exceptionally strong bull, and the Russell also joined the S&P with a first day signal to the bull side. Overall market trend strength is strong in terms of this being up over 80, and certainly it's even curved upward. Hedge warning status 0 plus, normal with some elevated conditions. And the three strategy opinions. We continue to have this warning with the option income strategies about the VIX being below the acceptable range of a 12. Indeed, we've even toyed into the 10 region in recent trading sessions. So very, very low premiums are being paid to take positions at this time compared to the amount of risk that's being taken on. And for novice traders, that could be a bit of a problem. Covered call strategies and put selling, we continue to be in position to initiate new positions for those strategies. However, a bit of conservativeness continues to be called for, considering that we're kind of in these extended price patterns, and you're just kind of expecting that at some point out there we've got a retracement. You don't want to be loading up too many positions in too many similar places and then have them all get kind of run over when we finally get something of a pullback. This market really does need to exhale some, and while we recognize that markets can exhale by either time or by price action, given how far we have come since the post-election rally, it's hard to believe that we won't have a little bit of a price action pullback at some point. When you look at the specific areas of warning, you can see most of these are relatively benign and weak. We have a very low VIX, of course. Distribution day count on the Nasdaq is only a 5. If it goes to a 4, it falls out of warning status. Skew is above a 130, so that's about an 11% probability of a 2 standard deviation move in the next 30 days. So this is about as quiet as it normally gets. Trend-based, we've got this really weak market phase 5. Actually, this one needs to be flipped. This is now at a strong bear first day signal. So that to combine with the New York Stock Exchange new high, new lows for the 1 month, up over 300 in the new high. So that's strong signal for the bulls. Now, another area of kind of neutrality is the key intermarket risk aversion indicators. All 5 are locked in a neutral stance. So most of these indicators are just kind of weak warnings, or more likely locked in kind of neutral stances. And even sentiment has been relatively neutral of late. Now, the intermediate term stocks is a bit elevated. And you see that the stock, the CNN Money's Fear and Greed Index has started to climb just a little bit, and it's now coming in at a 60 in the greed phrase. Sector-specific overall day, you see, was up 0.75% for the S&P, with financials leading the way. And you look at the breadth here. One of the morning authors mentioned this, and virtually every single company in that sector was positive for the day. Only, 4 companies were negative, and 1 or 2 were neutral. And then also very much a risk-on day: energy, industrials, tech. All up, and all up with very strong breadth. Defensives, let's see, utilities, telecom, consumer staples, real estate. They are at the bottom of the chart, but they're all strongly positive and with pretty solid breadth. So it's just one of those days where the tide swept everything up, and only consumer discretionary was negative. In terms of our market posture by sector percent change, you can see the areas of weakness are more likely to be transportation, telecom, consumer discretionary, energy, materials, retail, whereas those that are holding up best across all the different time frames at this point: consumer staples, healthcare, the financials especially, industrials, utilities have been coming up and improving of late, and then of course technology. The strongest here probably financials and technology across those 3 time frames. In percent change, we've been watching this kind of 1 month because we've been so sideways, and we're starting to see more and more separation between the winners and the losers in that 1 month time frame. And on the downside, you see energy and telecom down some 3 and 5% respectively. On the plus side, technology certainly has been coming on, up nearly 6%, and materials has been up about 5%, though it's given back some of that of late. You see the postures actually drop to neutral on the short to intermediate term time frames, and you see this position here on the 5 days and the 1 day. So some of these have started to wane a bit, at least for the short term. So kind of keep that in mind. The relative rotation graph, the regional banks that made this huge, strong swoop up, has been coming back and is on the verge of actually dropping into the bottom right corner. So that's regional banks. Also, you notice that IYT, which is transportation, and then XSD, semiconductor, have also been tailing down here into the weaker areas. Now, ones that are coming on would be IYZ, which is telecom, though it did kind of roll a little bit this last week. It's moving in the right direction in that it's actually moving towards the upper right quadrant as opposed to the ones that were already there and falling. So that might be somewhere to kind of check out this week. And I think that's enough for our report today. Let's go ahead and wrap this thing up. A typical Monday, we're a little bit over 20 minutes. I'm going to slide through these slides. If you see something of interest, just hit the pause button, grab your hyperlink, grab your additional details. Same thing through here with some of the subscription offers and membership offers that are available. And here we go with the disclaimers. Pause if you need more time to read the disclaimers. Also note the hyperlink down here at the bottom for the full set of disclosures. We'll be back next for tomorrow's market preview from Falcon Global. In the meantime, manage that risk profile, and then of course look to learn something about your trading each and every trading session.